Now, again, I just want to introduce myself. My name is Wesley Boudreau, one of the financial advisors here at the Retirement Group. And again, today we're going to talk about NUA, which is net unrealized appreciation, and how it affects ExxonMobil employees as they transition into retirement. And we'll talk about some of the significant tax saving strategies we look at here at the Retirement Group when we do work with ExxonMobil employees. And before we get started, I just want to remind a couple things. Again, the Retirement Group, we're an independent financial advisory firm. We are not employed by, nor are we endorsed by ExxonMobil. If you do have any questions throughout the course of this webinar, there is a Q&A box there. Feel free to jot down your information. It is anonymous, so your name will not be displayed, and I'll be sure to try and address that at the end of the webinar. If we have quite a few and we don't get to everything, give us a call, and we'll be happy to address that, or we'll follow back up with you as well on some of those questions. Also, we do have a chat box here, so we'll be putting some information in there periodically throughout the course of the webinar, different items as far as how to follow us on LinkedIn, how to set up an appointment with myself or one of the other advisors, as well as any pertinent update information for ExxonMobil employees. Now, at the end of this, we may also throw in there a link, or you may get an email for a survey to let us know how we're doing on these webinars and helping us keep the content fresh. And if you take the time to fill that out, I think we've agreed we're going to send a box of cookies your way as well as a thank you. So, for those of you who haven't been on one of the calls in a while and haven't sat down with us in a while, I just want to remind everybody who the Retirement Group is. Again, we are an independent financial advisory firm that focuses on working with corporate employees and helping them transition into retirement. We've been doing this for right around 30 years or so. We work with about 25 some odd companies, and obviously ExxonMobil is one of the large companies we do a lot of work with. We've been working with them extensively for a long time. The reason we only choose select companies is it allows us and our advisors to have a deeper understanding of your benefits plans inside and out, so we can help you through that transition process, help you avoid a lot of the different mistakes and pitfalls we see from time to time that individuals suffer if they're not working with an advisor, or they're working with an advisor that just doesn't know the plans. There's a lot of benefits at Exxon, and you can leave money on the table. NUA is one example of that, where a lot of other advisors don't understand the intricacies and don't understand how Voya actually does a transaction, and they can cost their clients quite a bit of money. So it's something to review. Now, we do have offices throughout the country, so rest assured, if you'd like to sit down and talk with one of us face-to-face, we can probably make that happen. But obviously, during these times, we're open to web meetings, phone calls, emails, fax, all that as well. At the end of the day, if there's anything you take us up on, even if you don't become a client, is to run a cash flow analysis. This is a complimentary plan that we can run for you to give you an idea of where you stand right now on your goals for retirement, to let you know if you're on the right path, if there's any adjustments you need to make. And that goes for whether you're looking to retire in 10 days or 10 years, or maybe you want to look at, can I retire now versus 2 or 3 years down the road, and how a lot of different items affect that, especially the benefits plans like the pension, which we have other webinars on, which will go into detail on that. Or you can give us a call and we can go through how that's going to affect you, especially with these low interest rate environments we're in right now. So, but today we're going to talk about NUA. Again, that's net unrealized appreciation, and it's a special tax treatment that's available to you as an ExxonMobil employee, where if you've maintained the Exxon stock, there are some favorable tax treatments when it comes time to distribute that. And those savings can be, if not thousands, tens of thousands, sometimes even over $100,000 in taxes in the immediate picture, and especially in the long-term picture as well. So if you never knew what NUA is, and you just took distributions from your 401k or rolled it to an IRA and took distributions, for the most part, many of you, the bulk of your account is going to be pre-tax money. So eventually you're going to be paying taxes on it as you take those distributions. Now, NUA, what happens is if you've got low cost basis stock, which if you have invested in Exxon, even if it's just a company match, and you've never sold it or traded it, chances are you may have some. What's going to happen is you're going to pay ordinary income taxes on the cost basis, and then the difference, the gain, you'll actually pay long-term capital gains once you eventually sell it. Not when you distribute it, but once you eventually sell it. And historically speaking, long-term capital gains has always been lower than your ordinary income tax bracket. So that's where the tax savings can come into play. And we'll give an example on that and talk a little bit more about those potential savings as well. Now, just want to remind everybody too that there is what's called a triggering event as far as exercising NUA. It's not something you can just do whenever you want. Those triggering events are either when you turn 59 and a half, and or separate service, or death and disability. So we don't want to talk about the last one, but what happens is once you turn 59 and a half, or if you're separated. So some people, if they leave Exxon before 59.5, could actually have two triggering events. So what happens is once that triggering event has passed, if you want to exercise NUA, it's an all or nothing transaction. You need to, if you process NUA, you need to roll over the rest of your account in that same year in order to process it correctly. Otherwise, it will not be validated. Now, if somebody, let's say, retires at age 56 and they don't touch the account for a couple years, and then 59.5 crosses, then that's their last time frame that they can do it. So they will only have one chance to do it in the future. If somebody retires at 61, they only have one chance to do it NUA in the future. Because if you take any withdrawals in any subsequent year after you've retired or passed one of those triggering events, NUA has to be done that year, otherwise you forego it forever. So again, that's one of the big mistakes we see a lot of people take. They may retire and they may take just a $10,000 withdrawal to cover a car note or do something, and all of a sudden, if they weren't keeping track of things, they've blown up NUA and lost the potential of saving thousands, if not tens of thousands of dollars. So let's take a look at a specific example here. Now, let's look at Lucy Norton in this case, and this is going to be kind of a vacuum example just to give you a good idea of how it works, and then we can talk about the Exxon plans in a little bit more detail. Now, in Lucy's case, so let's assume that she's got Exxon stock that's worth about $200,000 upon retirement, and the cost basis between what she and Exxon's put in there over the years is only $40,000. So it has grown from $40,000 to $200,000. So that growth, that $160,000, is what's called her NUA, her net unrealized appreciation, because she has not sold it. It's not realized yet. Now, for the sake of this example, let's assume that she doesn't need to or doesn't want to sell the stock right now. She's going to retire, and she wants to sit on it for another 10 years, and let's assume hopefully it doubles from $200,000 to $400,000. So if she didn't do anything and just took distributions from the account, it would be fully taxable. If she exercises NUA, then she's only paid in ordinary taxes on the cost basis, that $40,000 we talked about, and she'll pay long-term capital gains on the growth when she actually exercises that and actually sells the stock. So this chart will give you kind of an idea. On the left-hand side, we're looking at the tax treatment for NUA. On the right-hand side, we're looking at tax treatment for a lump sum distribution. So again, I said this is kind of a vacuum. Chances are she's not taking the full $400,000 out all at once. But in order to run the scenario, this is the best way to look at it. So let me kind of zoom in here so you can see a little bit better on this situation. If we look at it on the left-hand side, like I said, what would happen is when she exercises NUA, she would pay ordinary income tax on that $40,000, the cost basis. Then the long-term capital gains, that $160,000, she will not pay tax on that until she actually sells it. Now, the green box there, that's the future growth from $200,000 to $400,000. When she sells it, she'll pay long-term capital gains on that. Now, another caveat, and obviously these things can change, is that right now there is what's called a step-up in cost basis. So let's say that she did not plan on selling it, and she passed this on to her beneficiaries. That green portion would actually step up, and there would be no taxes owed on that. Now, this is something kicked around the administration where they may change this, so again, this can always be changed in the future as well. On the right-hand side, we're looking at the tax brackets, where if she were to cash that out at $400,000, she'd be paying various tax brackets. She'd pay the 10%, the 12%, the 22%, the 24%, and then she'd cap out at the 32% tax bracket to get her her average tax rate. So what we'll look at is how much is she going to be looking at paying if she were just to simply exercise NUA and then liquidate the stock in 10 years, versus if she were to go ahead and liquidate, roll it over and liquidate it, or just liquidate it off from the 401k and take a distribution at that time frame as well. So if we look at this, for her situation, if we look at the NUA being exercised, on the left-hand side, again, she's paid ordinary income taxes on that $40,000, and she'll go through two tax brackets, but ultimately her taxes due on that will be about $4,600. Then later on, after the 10 years, when she sells the Exxon stock, that $360,000, which again is the $160 in UA, plus the additional $200,000 in growth, she'll be paying long-term capital gains, which currently right now would put her in the 15% long-term capital gains bracket. There's a 0%, 15%, and 20% depending upon your actual tax bracket. So her average there is going to be another $45,000, almost $46,000. So when those are both added up, she's spending just over $50,000 on taxes for that $400,000. Now, on the right-hand side, if she were to liquidate that completely, again, we mentioned she'd go from the 10% all the way up to the 32% tax bracket. It would cost her about $96,000 in this case. So ultimately, in this vacuum example, as I mentioned, she would actually be saving about $44,000 on this transaction. Now, I say a vacuum because, again, remember, chances are you're probably not going to take out a full distribution or liquidate $400,000 in a given year. If you're working with us and you don't have NUA options, we're going to work with you managing taxes and help you stretch that out over years. So maybe she took the distribution over 2 years or 3 years, but either way, she's still probably going to be in that 24% tax bracket, maybe 22%. But for the most part, when we work with Exxon individuals, most of them either single or filing joint, a lot of times end up in that 22 or 24% tax bracket based upon the normal expenses that you may see. And again, that long-term capital gains bracket is 15%. So let's use a quick rule of thumb. Let's assume that you're in the 24% tax bracket. You're paying 15% in long-term capital gains. So the savings is going to be 9%. So in her case, if she had an NUA of $160,000, let's just round it up to 10% savings, it would have saved her about $16,000 right now. Or if you fast forward, it would have saved her about $36,000 or so probably in the case. So maybe not the full 44, but probably 36 or so. And every case is going to be unique and different. The benefit is if you give us a call, we can walk you through it. Or if you can get a copy of your most recent VOIA statement over to us, we can run a detailed cash flow analysis, but also an NUA analysis for you. What we'll look at is the cost basis, which is usually found on the third and fourth page. A pretty unique thing about Exxon is that they don't just use an average cost basis like most companies do. They give you line by line your historical cost basis. So there's a lot of individuals we work with that have cost basis going back to $11, $14, $15 a share. So we can go through there, run a spreadsheet, and look at maybe exercising NUA on things that are $30 or $35 and below, or even lower if you want to, and go through various scenarios to show you what the potential savings would be. Like I said, it could be just a couple $1,000s, or it could be $10, $20, $30, $40,000, or even more, depending upon how long you've held that stock and how much stock exposure you have. Now, with the pullback last year, obviously some of the NUA benefits were reduced, but now we're seeing Exxon rebound quite a bit. So NUA is again a story to be aware of as you do transition into retirement, especially if you have some Exxon stock in there. Now, one of the best ways to kind of tie all this together is to run that cash flow analysis I mentioned before. Right now, about 3/4 of Americans over 50 don't actually even have a written plan. If you can spend about maybe 10-15 minutes with us gathering or updating the information we have already on the plans and your spending needs for retirement, then we can run that cash flow analysis for you, let you see if you're on the right path, and also give you some alternatives if you want to look at different retirement dates or different spending rates and things like that. But once we get that, it can also help you back into some investment strategies for the 401k, or if you are looking to retire, options for rolling over to an IRA. And we can also dig deeper into the pension choices you have with Exxon and the difference between the annuity versus a lump sum, especially with the interest rates changing. So again, with that, I want to wrap it up. We just want to spend a little bit of time on NUA. Like I said before, it's a case-by-case situation, so the best way to really see what your situation is to give me a call, and we can run that analysis for you and let you know if it's worth looking at. Sometimes if you've traded stock and gone back and forth in it, you may not have NUA capabilities because you've traded away the cost basis, or maybe in some case you don't have that much exposure and it may not be worth the savings. But if you do want us to run that, we can definitely uncover the potential savings for you, not just now, but in the future as well. So if you have any questions, again, give us a call at 1-800-900-5867, or you can reach us at info@theretirementgroup.com. You can also hold your phone up to one of these QR codes here. There's one to schedule a meeting with myself or one of the other advisors, or there's one to follow us on LinkedIn if you want to make sure you get the updated information we have on Exxon as it comes out as well. And we remind everybody, if you have a question, go ahead and put that in there. It is anonymous. I'll be happy to address them. I've got a couple here, so I'll hit on those, and then we'll go ahead and close it out. But the first question I have on here is I already rolled over. Can I exercise NUA in my IRA? So unfortunately, if you've rolled over your account from the 401k to an IRA, you cannot. The NUA is only capable within the 401k, and it's only on the Exxon stock that you have in there. So that's why I talked about the triggering events and things like that. It's very particular as far as processing it. So if you rolled it to an IRA, no, you cannot process NUA anymore. And then they got another question here is I think I just answered is can I exercise NUA on my other accounts or my other shares? And again, it's just the Exxon, just the company stock basis is what we can exercise the NUA on. And then another one. This is a good one. I probably should cover this more, but it's can you tell me the process in actually doing this with Exxon? So this we can spend more time on this one-on-one, but this is why I mentioned working with us versus other advisors, because we've done so many NUA transactions. We know the process at Voya, and I hate to say that it can become a tedious process depending upon who you get on the phone. But what's going to happen is once we determine if you want to exercise NUA and you have separated service, you've passed those triggering events, and it makes sense for your tax bracket that year. In some cases, we'll run it and tell you, hey, you need to keep it in the 401k until the end of the year. We'll exercise it next year because it's going to put you in a better tax bracket situation. So we'll run through all that with you. But what's going to happen is we'll pick the amount of shares that we're going to exercise NUA on. Let's say shares that are $30 and below, for instance. What will happen is Voya will actually have computer shares through the transfer agent create a new account for you over there. They will transfer those shares over to computer shares in a brokerage account under your name, and then you'll get a 1099 in order to pay the taxes on that cost basis. So if we go back to Lucy's example, that $40,000, she'd have about $200,000 of Exxon shares moved over to computer shares. She'd get a 1099, so she's responsible for paying taxes on that $40,000. Once it's in computer shares, give it about a month or so to get the statement. You can leave it there, or if you're working with us, we can transfer it over to Charles Schwab, who's our clearing firm that we use, and then we can help you monitor it and help determine an appropriate sales strategy down the road, whether it's 10 years down the road or never, because you want a step up in cost basis or something like that. And then what's going to happen is the rest of the account. So let's assume in Lucy's case, let's pretend that she had 200,000 of Exxon stock and she had 500,000 total. So that other $300,000 would have to be rolled over to an IRA. Again, if you're working with a retirement group, we'd roll that over to Charles Schwab. So in the end, what would happen is in Lucy's case, you'd have two separate accounts. You'd have a rollover IRA for $300,000, and you'd have a brokerage account for $200,000 with ExxonMobil in it. And then that IRA, we can diversify it and help you manage that if you want, or you can do it on your own. And then the Exxon stock, again, there's going to be no future taxes until you physically sell that, whether that's a day away or whether it's 20 years down the road. All right, so again, I just want to remind everybody that if you have any questions that we didn't cover today, feel free to give me a call. You can reach us at 1-800-900-5867. But again, each situation is unique because of the way Exxon does the cost basis, and even more detailed if you have after-tax assets in there, that can be a factor as well as far as paying down the taxes or looking at a Roth rollover. So it gets a little bit more complicated, but just get us a copy of that statement. We'll be happy to run through it in detail and show you all the potential savings that you can see. I want to thank you, and I hope everybody has a great day.
Good afternoon, everyone. Thank you very much for joining us today. My name is Patrick Ray. I am one of the retirement advisors here with the Retirement Group, and we appreciate your attention. Hopefully, you'll gain some value out of spending some time with us this afternoon. So if it's the first time in visiting with us, we appreciate your attention. Thank you and welcome. And if you've seen one of our workshops or webinars in the past, welcome back. And so there's a couple of things that I need to cover before I pass today's presentation off to Tyson, my partner, to cover the material today. And one of them is, first and foremost, that we do not work for ExxonMobil, nor do we work for Voya. We're an independent financial planning and retirement planning firm. And our experience comes with the meetings and time that we spent with employees of Fortune 100 companies over the years and helping them plan for and achieve a successful retirement. And one of the ways we do that is through the educational tools that we have, of which the webinar today that you'll hear is one of them. And so you'll also find some links that'll be dropped into the chat for you to get access to previous things that we've recorded that you can watch and peruse at your own leisure, as well as our ebooks library that has a ton of great, short, easy to read materials on specific topics that we've known over the years have been questions and concerns for people, as well as the ability for you to reach out to us and spend some time with us if you're open to receiving one of our complimentary services, which is a cash flow analysis that we do. And so if you haven't had a chance to stress test your overall retirement plans, this may be the time to do it. And if you've done it in the past and you haven't had it updated in the most recent 12 to 18 months or so, now would also be another appropriate time to have that updated. We're willing and delighted to spend some time with you in the event that you wish to do so. And so we'll give you the whereabouts and the things to do to reach out to us in the event that you're open to that towards the end of the presentation today. So with that, I'd like to bring on my partner today, Tyson Maver, to cover the material. Tyson.
Thank you, Patrick. Thank you, folks, for joining our afternoon webinar series today. My name is Tyson Mavar. I'm one of the ExxonMobil retirement advisors for the retirement group here in Texas. And today we're going to talk a little bit about the ExxonMobil savings plan for some of our clients that are retired and left their money in the savings plan, or those of our clients and prospective clients that are still working at the company. One of the best ways that you can maximize your retirement paycheck and maximize the confidence that you're going to have in a successful retirement is by utilizing this savings plan successfully. So we're going to talk about some of the rules on the plans and some of what we found to be good strategies for active and retired employees in using this ExxonMobil savings plan. Those of you who aren't as familiar with us, the retirement group's been around a little over 30 years. We've been helping corporate employees plan for and transition into a successful retirement. And we also manage retirement assets. We do that through Charles Schwab. And we hope that if you're considering working with an advisory group in retirement, that you might consider our company. And we feel that we're very well tuned into the ExxonMobil strategies and the ExxonMobil retirement process to be able to guide somebody into a successful retirement because of the experience that we have in working with folks. A whole host of complimentary services Patrick mentioned a few of. And we encourage people to just spend a few minutes with us, talk to us about your retirement plan, how far you think you're away, what your considerations are on the pension plan, whether to take as a lump sum or an annuity. And we believe that we can add some value to the decision-making process once it comes time for you to leave the company and transition from an ExxonMobil paycheck into a retirement paycheck that you create on your own. Now, one thing that we always discuss in our seminars is this checklist to a comfortable retirement, and something we encourage somebody that has not retired yet to be considering. And first and foremost, it goes through understanding our emotions and the comfort in our decision-making process. It's very comfortable for most people that we've worked with at ExxonMobil to have a large portion of their net worth in ExxonMobil stock, because that's the company they work for and the company that they know the best and have confidence in. Unfortunately, it might not be the wisest or most rational long-term financial decision, as we've seen in the last few years, to have all of your retirement savings in one company. So we talk about this in a variety of different areas, such as the timing of your retirement. Sometimes the most comfortable time to retire is not the best time to retire, as well as some of the decision-making process, such as how to take your pension. For some people, it might be very comfortable to take the lump sum on your pension, but not necessarily the best given a variety of different factors. Or on the same token, it might be comfortable to continue getting an annuity from the company, but not always the best decision. And so in going through this cash flow analysis that Patrick mentioned, we can typically identify what are likely the best long-term financial decisions and start to identify some of the emotions and comfort that go into those decisions, try to remove the emotions from the decision-making process when possible, because that's often where we see the biggest mistakes made. We're also looking to reduce the risk of running out of money in retirement. That's the biggest concern for people that we work with, and our biggest concern as retirement income planners. Part of that is reducing volatility on your assets, which we do through diversifying, having different asset classes, and also identifying what cash flow needs to be produced in the retirement plan and when that cash flow needs to be produced. But it also goes into not over diversifying and reducing risk by buying good assets at a reasonable price, something we call value investing, versus just buying the entire market because we want to be diversified. We found that that helps our clients reduce their probability of permanent capital loss or losing their money in a retirement plan. Ideally, most people are working at ExxonMobil longer than they might need to so that they can increase their retirement paycheck. That's something we also focus on with people, is understanding the benefits plan so that you maximize what you walk away from the company with. But also number 4 on the list, minimizing taxes so that we can have a larger retirement paycheck and also leave more money to our estate or our beneficiaries if we don't spend all of our money in retirement. And taxes are where some of the biggest mistakes are made with some people that we've talked to in retirement. And it could be one tiny mistake that ends up being what makes or breaks your retirement. So it's something we focus on when we go through the cash flow analysis, and something that you can actually put some time and effort into while you're working so that you get to keep more of your money once you leave the company, leave ExxonMobil. And at the end of the day, we want to get to know you and your family in this process, build a relationship to understand what's important to you. Maybe it's estate planning. Maybe it's your investments and just making sure that you're maximizing growth. Or maybe it's principal protection and preserving your capital. All sorts of different values that we find when we're talking to people at ExxonMobil. And we've found that it's really important to understand what's important before putting together the investment plan and putting together the cash flow plan to be able to achieve some of those goals. Now, when we talk about the ExxonMobil savings plan, there's actually 2 forms. Not everybody qualifies for one of them, but there's the ExxonMobil savings plan, the basic plan, and there's also a supplemental savings plan that if you are what the government considers a highly compensated employee, you are not able to defer all of the money that goes into your savings plan, and you'll have a second plan set up that will be payable or taxed at least upon your transition from the company. So this is something that if you have, it needs to be considered in the plan, and we also want to talk about because it may change the ideal timing of your retirement because of the tax implications. But for the most part, we're talking about the basic savings plan from ExxonMobil. And the way this works is that you can contribute nothing if you choose to, but we encourage everybody that we talk to at least contribute the minimum 6% that's required to receive the 7% company match that has just gone back into effect as recently as last month in October. Now, you can contribute as much as you want, up to 20% of your salary. And there could also be limitations on that depending on what your salary is because of IRS limits. And that's something that we also work with people on, is really being efficient in what you're saving, how you're saving from a taxability perspective, and where the money's going, what different options that you're contributing to. And these can go into increments of 1% up to 20% of your salary. But you also have the opportunity to make a special contribution of after-tax dollars to your plan. And you can do this up till the end of the year, where you can basically write a check to your 401k plan. And there's a variety of instances where this makes a lot of sense, especially for those of you that are concerned about rising tax rates in the United States, like we are at the retirement group. This could be something to consider to start to get more of your money out of the taxable framework and more of your money into the tax-free framework, so that you have less uncertainty about the future of how much of your wealth you'll actually get to keep. Now, there's something called vesting, wherein the match that the company is giving you, you need to be vested for in order to take from the plan when you leave the company. So the vesting rules, you have to have completed 3 years of service or reached age 65, or if you pass away on the job, that will immediately become vested. And now you get to keep the matching contributions that have built up in your 401k plan. There's also Roth options that haven't been available forever, but a great way to diversify from a tax perspective what money is going into your plan. The default option is to contribute pre-tax, so you get a tax deduction on your income for what money you put into your plan. But in many cases, we encourage people to at least do a portion and potentially all of your contributions into the Roth option. Now, there's limits on how much you can contribute from an IRS perspective, and also from an age perspective into the plan from a pre-tax, post-tax, and Roth option in your 401k plan. So you have to be careful of these limits, but this is something that we work with people on to be as efficient as possible. And of course, with an uncertain future, we won't always be able to get it right because we don't know what your cash flow need will be necessarily, not exactly at least in the future. And we don't know where future tax rates are going to go. But by contributing some of your contributions to the after-tax bucket or the Roth bucket, you've at least diversified a little bit from a tax perspective and increased the probability that you will be minimizing your taxes in the future because you have multiple different options to pull from once you get to retirement. Now, the ExxonMobil 401k plan is very limited on its investment options, unfortunately, but it does a good job of giving exposure to employees of the broader market. So the options being common assets, which is effectively a money market account that pays a little bit more interest than most money market accounts. The equity units, which is also known as the S&P 500. Extended market units, which is also known as the Russell 2000 index. International equity units, which is also known as the MSCI EFA index, which is large companies overseas. The bond units, which is the aggregate bond index, broadly diversified across the available bonds in the market. The balanced fund, which is a combination of all options within the plan. And then, of course, ExxonMobil stock, company stock, which many people have made a lot of money over the last several decades, but unfortunately has severely underperformed the market in the last 6 years. Fortunately, this menu of investment options does not include individual stocks, and it does not include value indices. And most of these indexes, like the S&P 500, for instance, have increasingly been overweighting companies that are very expensive. I read an interesting statistic the other day that Apple, the technology company Apple, one company commands a larger allocation in the S&P 500 than the entire energy industry. So ExxonMobil, Chevron, ConocoPhillips, Phillips 66, EOG, you combine the entire energy sector and you are invested less in the sector than you are in Apple stock if you are buying the S&P 500. Now, not that Apple is a bad company to own, but it's just going to show that the index has become over allocated to expensive companies, or mostly technology companies, as the market has grown over the last few years. And what we at the Retirement Group advocate to all of our clients is value investing, which is trying to avoid expensive mistakes and buying companies when they're on sale at a reasonable price to their intrinsic value. When we start looking at the fundamentals of the company, things like their assets, their earnings, and actually looking at what the company as a business is doing. So not that this is a bad plan, it's a very inexpensive and convenient way to diversify across the board. But one reason that a lot of people will do a rollover of their 401k after they leave the company, once they have the ability to do so, and sometimes even before they leave the company, if they're given that option, is to start to buy lower risk investments and be more selective with the companies and businesses that they're owning in their plan. Now, there's dividends that are paid directly from the ExxonMobil stock. That is an option in the 401k plan, and employees have an option to pay themselves this stock as a dividend, which becomes ordinary income when it's paid out directly to you. You could defer taxes on that dividend if you have it reinvested in the plan. And you can also have a portion of this paid as a dividend and a portion kept in the plan. One of the reasons we focus very heavily on the net unrealized appreciation strategy, which is a way that you can pay a lower tax rate on your ExxonMobil stock, certainly the appreciated shares of your ExxonMobil stock, is because it'll allow you to pay the qualified dividend tax rate, which currently is 15%, as opposed to ordinary income taxes on your dividend, which could be 24%, could be 32%, maybe even higher, especially if tax rates go up in the future. So this is something that you should focus with us or whoever your advisor is on, is the implications of this dividend and certainly the tax implications of this dividend, not only at retirement, but while you're working at the company. And it's usually advisable for us to reinvest those dividends in the plan so that once you're in retirement, you just have more money. We have, unfortunately, a lot of people that are having all of their dividends paid to themselves while they're working, and they're just spending more money while they have a paycheck, and unfortunately, they have less money to spend when they're retired. So work with us on being efficient with how this dividend's being paid, and making sure that if you are reinvesting it, it's going back into investments that are going to minimize your risk and maximize what you have to walk away with when you leave the company. Now, the match was suspended, as most of you know, for 1 year, starting October of 2020 and ending just recently in October of 2021. This, of course, was the challenges that plagued the industry, ExxonMobil not being an exception, to reduce operating expenses. And what has been a big directive of the company for many years is maintaining the dividend that is paid out. Now, unfortunately, a lot of people lost their jobs within this last time through the performance improvement plans, and we expect to see that continue probably into next year. But the match is back, so making sure that you're being efficient with that match if you changed your plan while that match was not being put into your 401k plan, because this match is taking away from your total contribution that the IRS allows you to put into the plan. Not that that's a bad thing. This extra money is, of course, better, but you need to make sure that you're not over contributing to the plan. And if you can afford it, make sure you're not under contributing to the plan either, because on an annual basis, the IRS allows you to put up to $64,500 into the 401k plan. That includes the company match. And for many people, if you're able to, from a affordability perspective, but also from a salary perspective, some people make too much money to get up to this limit. We would encourage a lot of people to put money into the after-tax bucket, which is over and above the $24,000 a year limit that you are able to put in on a tax advantage basis. And there could be some great opportunities to get money into a Roth 401k and a Roth IRA to allow your money to grow tax-free for the rest of your life and even in future generations' lives as well. So we go through a lot of these different tax strategies and investment strategies when we do a 401k review. Usually the first step is to run a cash flow analysis to make sure you're on track for your goals. And once we have a good time horizon in mind, we can put together a tax efficiency strategy and start to figure out what investments are appropriate to get you where you need to be when you're retiring, whenever that time might be. So take advantage of the time that we're willing to spend with you. Of course, we're delighted to spend half an hour or an hour with you in an event that we might be able to earn your business. But more importantly, we're interested in maintaining a good reputation within the ExxonMobil community. So even if you don't do any business with us, maybe you're planning on doing everything on your own, or you have an advisory group that you're already very satisfied with, we're still delighted to spend some time with you, because chances are you might be able to reward us with some referrals to some of your coworkers, even if you never do any business with us. So take advantage, because the average American, unfortunately, only 30% of us have a written plan for retirement. This is unacceptable, folks, especially when so many groups are interested in doing one for you complimentary in an effort to get to know you and add some value before you make a decision on who you're going to work with. So please schedule some time with us if you haven't done so already. If it's been a while since we've reviewed your plan or had a conversation about your retirement plan, this QR code on the left will allow you to schedule a meeting with myself or Patrick or any number of our ExxonMobil focused advisors at the retirement group. And our LinkedIn page is a great way to stay tuned in with future content coming up about different ExxonMobil retirement strategies and generic retirement strategies for those of you that are no longer working at the company. With that, we're going to wrap it up. We appreciate everybody's time today. Patrick, I'm going to pass it back to you for any last minute housekeeping issues or any thoughts, or even if we have any questions on today's call, we're happy to field any of them.
Yeah, thanks, Tyson. Yeah, actually, we do have a couple of questions, so we'll get to those in just a moment. I just want to talk for just a second about the importance of the planning process, and specifically for those of you who are trying to maximize your 401ks, which I think in general we all should be doing to one level or another. And the reality is that we had fielded a lot of phone calls at the beginning of last year because of the COVID crisis and the pandemic that we were all dealing with respect to the concern of how they should address that inside their 401k. And I think it's really important to remember that the plan is consistent with what's important to you. So in other words, instead of trying to think in terms of having a need to make an adjustment because there's corrections in the marketplaces, which we may very well see in the not too distant future as an example, that you want to be mindful of having the things that are invested consistent with your goals and objectives and the tolerance for fluctuation and risk that you have. And one of the ways that you do that is by the plan that Tyson was referencing that I talked about at the very beginning and having a cash flow analysis done. So again, if you hadn't already done that, it's a lot of alleviation of pressure and concern on your end to get rid of the thought that you need to make an adjustment because something's occurring, like higher interest rates, or we're in an inflationary environment now, or the stock market has a correction and that kind of thing. And just think in terms of what's best for you and your family and the overall plan. Question. Here's a question for us, Tyson. You indicated the ability to move funds before, excuse me, you indicated the ability to move funds from before tax to after tax portions inside the 401k. What are the rules and limitations to accomplish this objective?
Yeah, great question. So there's a couple ways you could do this. There's an in-plan conversion where you're essentially taking pre-tax dollars in the before tax account and moving them to the Roth conversion account. There's no limit on how much you can do. You could convert your whole plan. And this is whether you're before 59 and a half or after 59 and a half, or active or retired. And so what this does, unfortunately, and the reason you might want to consider limiting what you did on this, is adds income to your income tax that year. So for instance, let's say you make $250,000 a year and you decide to convert $100,000 from the pre-tax bucket to the Roth conversion account. Well, now your income's $350,000, whereas it was originally $250,000, and you're likely in a higher tax bracket now. So this is, again, running the cash flow analysis, we can start to project what your future income looks like and see what might be a reasonable amount to not only minimize and maintain your tax bracket today, but get more money in the tax-free environment down the road. There's also what you can do is what's called an in-service rollover. Not everybody qualifies for this, but you can see it on the website in the withdrawals section. And you want to make sure that if you ever do this, it's a rollover that is not suspending of your contributions, because oftentimes you can do rollovers that will suspend your ability to contribute to the plan for 6 months, which of course you wouldn't want to do because you lose the company match during that time frame. But you could have an in-service rollover that's non-suspension. And this is actually a way that a lot of my clients did a test run of our services before they retired to move a portion of their 401k from Voya to Charles Schwab, where we custody our assets, to not only be more tax efficient, get that money that's after tax in the 401k into a Roth IRA, but then also expand the investment menu and have the option to buy Berkshire Hathaway stock, or buy an annuity, or buy a mutual fund that you didn't have an option to buy in the 401k. Just expand your investment menu. So whether it's in the plan or outside of the plan, this can make a lot of sense. And especially like we talked about that after-tax special contribution, you can do one of those and subsequently roll that money out to a Roth IRA, effectively circumventing the limitations on putting money into a Roth IRA, which many people make too much money to do it at all. And even those who don't make too much money have a much smaller limit on what you can directly put in a Roth IRA. Using the 401k while you're still working is a great way to get money into the after-tax and non-taxable environment where you can get tax-free growth and have a little more certainty on your future tax bill. Hopefully that answered the question.
Yeah, and I've got something to piggyback off that. We do have one more question before we call it an afternoon, Tyson, but to piggyback off of the conversion thought process, remember, one of the advantages of having a team help you is to maximize the tax efficiency of your retirement. And in doing so, as Tyson had mentioned, you have to be mindful of where you land on the tax bracket scenario. But as an example of what might benefit you, if you make, let's say, $80,000 and the threshold of the 12% bracket for married filing jointly is $120,000, then you could effectively convert somewhere between $35,000 and $40,000 without putting yourself in the next highest tax bracket. And it would be a really strong strategy for many of you to consider with respect to trying to ultimately lead to what is the most tax efficient version of your retirement. So this has to do with the checklist that Tyson talked about at the very beginning of not just thinking emotionally about when the best time to retire is, but to actually have a plan that's consistent with the best version of the plan for you and your family, which might mean paying some tax today in hopes of enjoying a little less in taxes down the road at some point. Last question. Can I roll over a portion of my Voya savings account to an outside 401k?
Great question. The answer is sometimes. Usually, and this is different, whether you're a Mobil Heritage, XTO Heritage, Exxon Heritage, it depends on the composition of your plan currently, how much you have in after-tax, pre-tax, the general account. The best way you could either call Voya to find this out, or you can go on the website and go in the withdrawal section and see if you qualify for non-suspension in-service rollover. So this is not a hardship rollover. That's something different. But in my experience, most people that I've looked at this with have an option. Some have more money than others available. And it's not an all or nothing. If you have, let's say, $300,000 available, you could do a partial rollover of a portion of that to get it to an outside institution, like we mentioned earlier, Charles Schwab or some other custodian that you already have an IRA or Roth IRA at. And so that would be something we'd review with you when we do the cash flow analysis to see if it's something that might be appropriate, might make sense for you.
Yeah, that's a great response, Tyson, of course. And, the whole point is whatever it is that you have questions or concerns about related to any of these things about how to manage your 401k or to make the most of it or to talk about the most tax efficient version of your retirement requires some attention on our part. And we're willing to spend some time with you if you're willing to spend some time with us. So you can reach out to us at 800-900-5867. You can also email us at info@theretirementgroup.com, or you can just simply Google the word Retire Kit and it will bring you to our landing page and send you in the right direction to get in touch with one of us. So with that, we appreciate your attention this afternoon. Thank you very much. We hope you found value from the time you spent with us today, and we'll see you on the next webinar. So we appreciate your attention. Have a great day.
Thanks, everybody.
My name is Wesley Boudreau, one of the financial advisors here at the Retirement Group. Today we're going to give you a quick update on the ExxonMobil pension plan, kind of a quick review, and then also let you know where the interest rates fall for the lump sum calculations for both the third and fourth quarter of 2021. Before I get started, I just want to remind everybody again that the Retirement Group we are not affiliated with, nor are we employed by ExxonMobil. Throughout the course of this, there's a couple items you might want to pay attention to. There is a Q&A box on the webinar screen. If you have any questions, feel free to put those in there. Your information, your name will be kept anonymous, and I'll be sure to try and address as many as I can at the end of the webinar. If we don't get to everything, we'll be happy to follow back up with you and provide those answers as well. There's also a chat box where we will be putting some information there. Some items may be information like how to follow us on LinkedIn if you want to stay up to date on all the Exxon information we have as it comes out. Also, if you'd like to set up an appointment with myself or one of the other advisors in the office. And then if you have any interest in it, we are looking to try and better these, so there may be a survey link on there to let us know, how we did with the webinar or any suggested changes or topics to do in the future. If you take a little bit of time to do that, I think we might be sending a box of cookies your way, so it may be worth at least that as well. Now, before we get started, I just want to remind everybody again who the Retirement Group is. Again, we are an independent financial advisory firm that focuses on working with corporate employees and helping them transition into retirement. We've been doing this for just shy of 30 years or so. We work with about 20 different companies, and Exxon obviously is one of the big companies we do a lot of work with. The reason we focus on just a few companies is it allows our advisors to have a deeper understanding of your benefits plans inside and out, so we can hold your hand through the transition process and help you avoid a lot of mistakes we see from time to time that retirees make, and also provide you some sound planning guidance prior to retirement as well. And we've got offices throughout the country, so rest assured if you need to sit down and speak with somebody face to face, we can still accommodate that. But obviously we can provide webinar meetings, phone calls, emails, fax, all that as well. And then one of the biggest things we do recommend that you take us up on, even if you have already and it's been a while, we can update it, but you need to run a complimentary cash flow analysis, especially for Exxon employees, because this is it's an analysis where we can take a look at your retirement date, look at your spending, look at what you saved throughout the company, and make sure you're on the right path to meet those goals. And we'll come back, we'll be able to tell you if you can successfully retire at the date you were thinking about, whether you can go earlier or whether you should stay on later. And once you have that, we can help you plan accordingly and maybe look at some different options from there. So again, it's not a one-size-fits-all, but it's very important to look at that and also review the differences on the pension plan, whether it's a lump sum or the annuity, which we'll talk about here momentarily. So as you transition, leave Exxon, there's really three common sources of income you'll be seeing. Number one, your Social Security. Generally speaking, you can take that as early as age 62 or defer it to age 70. But again, the full retirement age is going to be somewhere between 66 and 67 for most individuals. Now, if you have questions on this, we can actually run a Social Security analysis to give you a full breakdown of all the different claiming strategies for yourself, or if you're married, you and your spouse, and let you know what the best options are going to be for you. Now, you've also got with Exxon your 401k and your defined benefit plan. And the defined benefit plan, which the pension plan is what we'll talk about here today. But again, the 401k is going to be your defined contribution plan, in which case you and Exxon have been making contributions all this time, with the exception of the last year or so. But we're going to be looking at those coming back again soon. And that's going to grow or shrink depending upon the market movement and the performance of the account. And once you retire, you can start taking distributions from that or roll it over to an IRA. On the pension, you have the option of taking it as an annuity or a lump sum. So when we talk about those different choices, again, it's a defined benefit. It's a classic formula calculation, which we'll go over in just a second, that determines what your single life annuity payment is going to be for the rest of your life. From there, you have alternative choices. If you want to make sure that your beneficiaries get something, you can add a period certain to it, so that way it's going to be guaranteed for 10, 15, or 20 years beyond the original 5-year guarantee they provide. Or maybe you're married and you want to make sure your spouse is covered. You can look at a joint and survivor annuity, so that both of you are going to be covered as long as somebody is alive, and you can maintain a 100% payout, or it can drop to 75, 50, 25% payout to your surviving spouse if something like that were to happen. What we're going to talk about today is going to be the lump sum calculation. And again, what happens is the lump sum uses interest rates to determine what you're actually going to get paid in order for you to go and try and recreate that annuity yourself. So as interest rates change and interest rates come down and they're lower, Exxon has to give you that much more money in order to try and recreate that annuity. So that's what we'll talk about, the interest rates here. And the interest rates are going to be different for different people. For most people on this call, it's probably going to be the Pension Protection Act segment rates. The other option is the GAT rate, which is the 30-year Treasury rate. But that's going to be for those that have been around a little bit longer. You had to be over 63 and over 23 years of service at this point. So it still applies to some of you, but for most people, it's going to be the Pension Protection Act segment rates, which we'll go over. Now, as far as the formula for the defined benefit plan, again, it's going to be a formula to determine how much of a monthly income they're going to give you, and then all those other options I just mentioned are derived from that. So the formula is going to look at it's 1.6% times your years of service times your final average pay, and then they claw back the Social Security that they've been paying in for you over time. Again, whenever you get your check, Exxon pays half the Social Security tax and you pay half the Social Security tax. And as far as vesting, you just need to be there for at least 5 years, but then there's going to be differences as to whether you're a terminee or retiree as far as what percentage of this you will actually be getting as well. And then if we look at that breakdown, in order to be a retiree, which is very important, you need to be at least 55 years old and have 15 years of experience. So you want to make sure you make it to that number, because at 55 plus 15 or over that, you're considered a retiree, which is a lot better than being considered a terminee. A retiree is going to reach 100% of their pension at age 60. A terminee will have to wait until age 65. Also, a terminee does not have the lump sum options available to them. They just have the annuity options. And if you take anything prior to age 60 or prior to age 65, depending upon which one you are, the penalties are much more severe on the terminee schedule. So let's take a look. Let's look at somebody who's a retiree and figure out, okay, maybe I'm retiring at 57. Am I going to get my full pension? Well, the answer is no or maybe. So if we take a look at this chart, essentially as a retiree, any year you decide to commence your benefits prior to age 60, there's going to be a reduction for an age penalty, and it's essentially 5% per year. But again, it's not just a year-by-year basis, it's daily, so they calculate it out daily. So let's say somebody who's going to retire at 57 and decides to go ahead and take their pension at that point in time, they're going to have 15% reduction, so they're only going to see 85% of that pension provided to them. Now, they do have the option to actually to retire and defer their benefit. So they could retire at 57, and let's say maybe they go and work, consult or do something else for a couple of years. They don't need the pension. They can defer it out to age 60, so they get that 100% payment as well. It also goes hand in hand if you're trying to follow and track the interest rates for lump sum calculations. We worked with a lot of ExxonMobil employees over the last 2 years that we did this as interest rates were changing. They may have retired, but we had them hold off a month or quarter or two to actually claim their pension lump sum because interest rates were dropping, which meant their lump sum was going up. So let's take a look at how those interest rates change and how they affect the lump sum. So on this slide, you see this kind of seesaw pattern here. Again, I've mentioned it once or twice. As interest rates change, so does the lump sum. So think about it like a mortgage. When interest rates are low, you can afford a bigger house. When interest rates are high, the payments are higher for you. So what's going to happen is essentially as interest rates go down, which they have over the last couple of years, and they went back up, and then with the pandemic they've come down pretty dramatically, and bottoming out about the first quarter of 2021. So as those went down, essentially what's going to happen is Exxon looks at your income annuity, figures out how long you're going to live based upon life expectancy, and they're going to take a look at, okay, how much do we have to give you based upon interest rates for you to go out and try and recreate this income stream. So if interest rates are lower, they have to give you more money in order to try and recreate that. So we take a look at that seesaw. As interest rates go down, what's going to happen is the change in interest rates, about a 1% change in these interest rates is going to equal out to about an 8 to a 12% change in your lump sum calculation. So if interest rates go down by 1%, generally speaking, we'll say that your lump sum is going to go up by about 10%, give or take a little bit. On the flip side, interest rates have been low. They've been coming up a little bit, and if they keep going up, if they go up 1%, you could see your lump sum go down by 10%. So let's say you have $1 million lump sum right now, and interest rates go up by 1%. You can see that come down to roughly around $900,000 or so. So that's why it's really important to monitor those interest rates if you're looking at retiring in the next year or so, because if you're taking the lump sum, in theory, you could be working for free or reduced payment the last year of your career, because maybe you make $100,000 but you lose $70,000 in the lump sum. So the net effect is maybe losing, only working for $25,000. So the question is, do you want to do that? But again, we'll be able to keep you updated on the interest rates and give you updates quarterly on them, and let you determine the best way to pull that trigger. But let's kind of zoom in here and take a look at these rates so that you have a better idea of what we're looking at. Now, as far as I mentioned before, there's the Pension Protection Act segment rates, which are broken down to 3 segments. There's the first, second, and third segment. The first segment correlates to the first 5 years of retirement. The second segment correlates to years 6 through 20, and the third is going to be years 21 and beyond. And on the far right-hand side, we have the GAT rate, which is the grandfathered rates. This is the 30-year Treasury rate at 95%. So again, this is for only individuals that are over 63 with over 23 years of work. Now the rates, what they do is they use the last 2 months of the 2 previous quarters to determine what the interest rates are going to be for that quarter. So for fourth quarter 2021, if we go across, we'll see the short-term rates are going to be 0.62%, 2.77%, 3.43. We look right below there, the ones for third quarter right now is 0.6, 2.73, and 3.57. So a very, very minor change between third quarter and fourth quarter, and a lot of that's due to the rates coming down in June. And we've also seen them come down a little bit lower again in July. So that's not going to be used, but once we get August, September, that'll tell us what the first quarter of 2021, excuse me, the first quarter of 2022 is going to be. But if we look at these, and we go on the bottom, let me zoom back in, I apologize. If we look at the bottom, this is going to give you what the rates were about a year and a half ago or so, at the end of 2019, beginning of 2020. If we look at that middle segment, that's going to have the biggest effect on your calculation because it covers 15 years. But it was up in the fourth quarter 2019, 3.64. Now we're at about 2.77. So again, we're looking at that roughly 1% change or so in those. So if we just go back to where we were before, we could theoretically see that 1% change. The question is, how quickly will it happen, and what's your retirement situation? So that's why it's really important to run that cash flow analysis, kind of see where you are at this point, and then that way, if you're looking to take the lump sum, we can monitor those different options for you. So with that, I want to just go ahead and remind everybody, if you do have any questions, it's really important to run that cash flow analysis to dig into your personal situation to really give you the best answers. But just give us a call and we can schedule an appointment. You can reach us at 1-800-900-5867, or you can email us at info@theretirementgroup.com. I think some of those links were in the chat box for LinkedIn or for scheduling appointments. But if you're tech savvy, there's some QR codes up here. You can go and hold your phone up and get into that as well. And so with that, I want to kind of wrap it up. I want to answer one or two questions we have here, and then if there's any other additional questions, just give me a call. We'll be happy to go through them. But one that came in was can I change my my election? Okay, so it's going to depend on when you actually did this. So I talked before about the ability to retire and defer commencement. So we've worked with people where we've caught them kind of on the tail end of their retirement planning, or maybe they didn't do any retirement planning, and they'd already put in for their paperwork to get the election done. They retired and they were, let's say for instance, going to be going in the fourth quarter of last year. We saw this a lot. And we caught them before they actually finished in the paperwork in, but they'd already requested the election forms. But we explained to them, with the way the interest rates were dropping from fourth quarter to first quarter, and for some of these, the bump was about $23,000. Some were about $17,000 in the lump sum payment. So we explained to them, go ahead and cancel that and order new pension election forms for January of the following year in order to do that. So yes, you can change it, but that's prior to actually signing and submitting the information. So you got to be very careful on that as well. And then one other question, which and I apologize, I should have put this in there because we usually do, was the option to actually split the annuity and the lump sum. So again, one of the things Exxon did change about 5-6 years ago was made the election option a little bit better for you, whereas it used to just be either the lump sum or the annuity. Now you can also break that up. You can take it on a split strategy where you can break it up in 25% increments. So maybe you can do half annuity, half lump sum, or 25-75%, vice versa. And that's one of the other issues we mentioned about the running the cash flow analysis. So we can run those different scenarios to show you what it looks like, not just now, but in 10, 20, 30 years down the road. So you might want to run 3 different scenarios for different dates. Maybe you want to say, okay, if I'm going to retire at the end of 2021, what does it look like if I take the entire lump sum, or maybe a 50-50, or maybe 100% annuity? We can run those side by side for you to show you what it looks like down the road and explain all the different pros and cons to that as well. And then also, again, adjust the dates. But so that's why it's most important to kind of run that to see exactly where you stand. And then from there, if you need help or guidance, then we can obviously help you with the investment side of things as well. But to keep it short, I want to wrap it up there. So if anybody else has questions, feel free to give us a call. We'll be happy to go through it. But I just want to remind everybody again that you can reach us at 1-800-900-5867. And again, it's important if you're looking at taking the lump sum or leaning towards a lump sum for the ExxonMobil pension plan, that you have a good understanding of these interest rates, or at least give us a call so we can keep you up to date on them as well. So again, I want to thank everybody for taking a little bit of time out of their day, and I hope you have a great day.
Good afternoon, everyone. Thank you very much for joining us today. My name is Patrick Ray. I am one of the retirement advisors with the Retirement Group, and we appreciate your attention today for today's webinar, which is for our ExxonMobil folks and an emphasis on retiring on purpose with purpose. And this is a great series for us to bring to you to talk you through some of the things that you want to be mindful of when you're preparing for one of the most important financial decisions that you'll ever have to make. And so if you have not been to one of our workshops before, welcome. We're glad that you're here. And if you've been to some of our series before in the past, you'll know that our experience from dealing with ExxonMobil folks in the past has come from our experience in Fortune 100 and Fortune 500 company employees and preparing them to enjoy a successful retirement. And one of the ways we do that is through this educational process of bringing these webinars to light to you. And we also have a number of other tools that you'll find available through the chat today. There'll be links to get you access to our ebooks library and our website that has a ExxonMobil retirement guide and Also a way for you to schedule some time with us if you have some questions that you might have specific related to your circumstance. But in case you have some general questions, you're welcome to type those into the question and answer box so that we can get to those at a later time, because we'll have time towards the end of the workshop, hopefully today, to answer a few questions. And it's pretty important that if you didn't already know, we have no affiliation at all with ExxonMobil, nor do we have any affiliation with Voya, the administrator of your retirement plan. And as an independent firm, our responsibility for the most part is to try to educate you to the best degree we can to provide you value so that if you're looking for a partner in retirement, you might select someone like our firm to help you. So without further ado, I would like to bring Tyson on for today's presentation because he'll cover today's material. So Tyson, are you ready?
Yes, thank you, Patrick. And thank you, folks, for joining our webinar series this afternoon. My name is Tyson Mavar, one of the ExxonMobil focused retirement advisors for the retirement group here in Texas. And today's webinar is entitled Retire on Purpose with Purpose. This next 12 months, we're anticipating is going to be one of the most popular times in history to retire from ExxonMobil. And many of you know that we've been working with ExxonMobil employees for more than 2 decades. And so there's a variety of considerations that we'd like to bring up today that many of you probably had some of them, but we've been working with ExxonMobil employees very closely because of all the opportunities that exist for somebody considering maybe not necessarily a retirement, but a transition from ExxonMobil. So today we're going to talk a little bit about those. Those of you who aren't as familiar with us, the Retirement Group is an independent financial planning organization that specializes in working with corporate employees. And we have several advisors throughout the country that have a unique knowledge related to the ExxonMobil retirement process and the important issues that somebody goes through in transitioning from ExxonMobil to maximize your benefits, minimize your taxes, and ultimately have the most successful and comfortable retirement possible. Patrick mentioned the cash flow analysis, a great tool that we offer complimentary for all employees. If you haven't done one yet, or if it's been a while since we've updated yours, I strongly encourage you to take advantage of that complimentary service. And we have offices throughout the country. So whether you're here in Texas or maybe in California or Oklahoma, wherever in the country you are, chances are we have an office nearby. And as a matter of fact, in the last year, we've been doing a lot more web meetings that have been more convenient for people to do some retirement planning from the comfort of their own home and at whatever time is convenient for them. So I personally am on the campus about once a month, the spring campus in Houston, but we have offices throughout the country. So let us know whatever's most convenient for you if you'd like to either have us run your plan or do an NUA analysis, or maybe just look at your Voya 401k plan and do our best to make some suggestions on how you might be more efficiently allocated in that account. We're happy to help in any way that we can. The QR code here is a way to get access to our LinkedIn page. If you have LinkedIn, I encourage you to follow us on there so that you can make sure to keep up with the content that we're coming up with related to the ExxonMobil benefits, as well as retirement planning in general. And we'll have a way for you to schedule a meeting at the end if you have interest in talking to one of our ExxonMobil focused advisors, regardless of where you are in the country. So today we're going to talk about the important considerations on retirement. Retirement is both a financial decision as well as an emotional decision. For many people that we work with at ExxonMobil, a lot of them worked for the company for several decades, maybe more than half their life. And so it's an important decision that you'll go through to become financially ready, of course, to retire, but also to become psychologically prepared to transition and make one of the biggest changes you'll have in your life. So it comes down first to understanding the emotions that go into this decision-making process. And there's emotions throughout all these decisions, whether it's the timing of your retirement, the way that you take your pension, whether as a lump sum, as an annuity, or maybe a combination of the two, the investments that you have, when to sell your ExxonMobil stock, maybe not all of it, but at least a portion of it, because that's an asset class that we found is far too heavy in our clients' portfolios when they leave ExxonMobil, and something that we takes a lot of time to prepare for as people leave ExxonMobil. But there's always going to be some emotions in the decision-making process, and ideally, we would like to remove them when they come to important financial decisions. But it's very difficult, if not impossible, because we're all human and we're not robots. Our brains operate sometimes based on comfort and emotions. The cash flow analysis we found helps to remove some of the emotions from the decision-making process and helps us to ultimately make decisions that are in our long-term financial best interests, even if they're not always the most comfortable decisions. And we also find that there's emotions involved in the investment process, and that comes into the transition from being actively employed and accumulating assets to retired and now distributing your assets to yourself in the most tax efficient manner possible. And oftentimes investing those assets is not the easiest process for a lot of people, especially if you don't have a track record with individual or a team that's supposed to help you with this. So this is why myself and Patrick and our advisors encourage people to get started on this ahead of time. Don't wait till the quarter that you retire to interview 4 or 5 advisors, because there's a lot happening in that time frame, and that's when mistakes are made, when decisions are made under duress. So we prefer to spread out this planning process, and this is why we do these so frequently, to be a complement to the Ernst & Young planning resources that you have at ExxonMobil, so that you can get yourself mentally prepared for some of these very, very big decisions. I have one client that he opened a small account with us 3 years before he retired, and he didn't anticipate retiring for another 10 years. But still to this day, we talk about how thankful he is that he started that process ahead of time, because it made retirement a lot easier. He had a track record and a relationship with myself personally, and it just made those decisions that he had to go through a lot easier. So we encourage people, start that, and maybe interview a couple different groups, and maybe open accounts with a couple different groups before you retire, so you can find out where the best fit is. And maybe it's with the retirement group and maybe it's not. Now, investing money, of course, there's going to be trade-offs. The more growth, as you know, that you want, you're going to have to take a little bit more risk or experience more volatility. So this becomes a process to get ready for what your expectations are for growth on your investments, what cash flow your investments need to produce to create a comfortable retirement, and also what's going to be the most tax efficient allocation across all your accounts. And most people we work with at ExxonMobil don't just have an IRA. Oftentimes we'll recommend leaving some or all of their money in the 401k. Oftentimes we'll recommend opening up a non-qualified, a non-retirement account for their low-cost ExxonMobil stock, strategy known as NUA, or net unrealized appreciation. And especially today, we're recommending people have a Roth IRA, either funding a Roth IRA or doing Roth conversions in an effort to plan for and prepare for higher taxes in the future throughout your retirement. So sometimes this becomes complicated, but it's very important in putting together the most efficient retirement strategy possible so your money lasts as long as it needs to, which of course is the rest of your life. Now, of course, we want to maximize our income. Most people do, at least. Some people want to maximize their retirement legacy, but I would argue that most retirees of ExxonMobil are primarily concerned with having the biggest retirement paycheck possible that is also sustainable, meaning that they're not going to run out of money. And so part of that is understanding your benefits, minimizing your taxes as you approach retirement, through the transition to retirement, and throughout your retirement. And we do that through going through this cash flow analysis exercise so that we can start to not necessarily predict the future, but prepare for the possibilities that are coming our way. We're going to talk a little bit about taxes and inflation in a moment here, but it's just very, very important to put that plan together and then update that plan periodically, as we can't predict everything in the future, and we need to be flexible and have the ability to pivot in our retirement plan when it permits. And then ultimately develop a philosophy about our retirement. And this is where we like to work with our clients well before they retire, so that you can have a game plan of what you're going to do after you leave ExxonMobil. And it's important in retirement to have a schedule, hopefully a better schedule than you had when you were working, but to start to prepare for that, because sometimes people, whether it's because they retired by force or because something happened in their life where they retired earlier than they expected to, they're just not ready to do so, and they wither away because they haven't set up what their retirement means to them. And it means something different to everybody. I have one client that just retired a couple months ago. His plan is to open back up his barbecue truck and actually serve food to corporate employees that are still working. which is something that he loves to do, something that he can actually generate some income doing, not nearly as much as he was while he was working, but he doesn't need to, so it's not a big deal. And then I have another client that retired at the beginning of the year when interest rates were a little bit lower on the lump sum. He's actually renting out his house to his daughter, giving her a good deal, her and her kids a good deal on his house. And he and his wife are traveling the country in their RV that they recently purchased and financed at a very low interest rate. And they actually get to come back to his house when they want to, but they plan on spending most of their time in their RV in different parts of the country they haven't yet got to explore, and still maintaining their home as an asset if they ever want to sell it down the road. So, retirement's different for everybody in terms of what your plans are, what your values are, what your expectations are. But it's very important to start thinking about what you want your retirement to mean to you, so that once you get there, you already have a game plan set up and you are smoothly transitioning into what you want to be doing versus what you had to be doing while you were working. So today we're going to talk about the current opportunities here in 2021 and why a lot of people are considering retirement, some now and some within the next 6 to 12 months. Many of you have heard about interest rates, and many of you know that the interest rates directly correlate to your lump sum payout. The lump sum is not right for everybody. And I have a lot of clients that have, over the last few years, once they made it available back in 2015, taken a partial lump sum with a partial annuity on their ExxonMobil pension. But this is a big asset. For most people we work with, that's the largest resource they have for retirement is in that pension plan. So it's important to start to understand the options, understand the benefits and detriments of different options, and run your retirement cash flow scenario or analysis with different scenarios, looking at maybe the full lump sum compared to the full annuity and a partial lump sum with partial annuity. If you're married or have the possibility or interest in having a joint annuity, so you have somebody else who's protected with a lifetime income stream, this makes the process even more complicated and more important to spend time on. So lots of great options on the pension, very flexible plan that ExxonMobil set up for its employees, but it's an irrevocable decision. And not only is the choice that you make on your pension benefit important, but the timing of this is incredibly important. And today we're in a low interest rate environment, so we'll talk about those in just a moment. Real estate impacts on your retirement. We're going to talk a little bit about that and what's happened recently with the real estate market. Inflation, where we are today, and the importance of understanding inflation and how it pertains to a retirement portfolio. And understanding all of the different considerations in retirement, the important decisions you go through, and some things that we found our clients found to be important through this decision-making process. We think it's important to understand and also talk to a lot of people. Maybe if you still communicate with some of your retired coworkers on some of the benefits of their retirement or some of the good decisions they made and maybe some of the decisions they might regret, so you don't make any of those mistakes that are so commonly made in this process. Now, there's 4 sources of funds for a retirement income plan. So of course, the pension, whether you take it as a lump sum or as an annuity, is going to be one source, often the biggest source we work with employees at ExxonMobil on. The 401k plan, as it turns out, that 401k match is coming back in October. It was suspended for a year, unfortunately, but it's coming back. And we're definitely spending some time with our clients, especially the ones that aren't planning to retire anytime soon, understanding the role that that match plays and how to be more tax efficient on how you save inside your 401k now that there's a little bit more money going into that account, or will be after October 1st. Social Security is still a very important source of funds. And especially if you are married, there's going to be a lot of options in how you take that. And we want to do our best with the highest degree of certainty to maximize what we pull from that throughout our lifetime. And then especially today with real estate prices and values increasing so rapidly in the United States, if you own your home or have equity in your home, this is an asset that needs to be considered as a part of this 4-legged stool that we consider to be our funds available in retirement. So first and foremost, interest rates. This is something we've sort of taken for granted because rates have continually dropped over the last 10 years. I've been with the retirement group for almost 11 years now. And we had some of our clients back in 2011 taking a lump sum back when the grandfathered interest rates were 4.5%, almost 5%. Many of you that know those rates are closer to about 2%, actually lower than 2% today, which is producing higher lump sums. Now, as it turns out, they changed the rules to where not everybody's grandfathered into using the treasury rate. As most of you probably know now, whether or not you're grandfathered, but the rule is you have to be 64 years old at least, with at least 24 years of service by the end of this year, by the end of 2021, to be considered grandfathered. And this is a benefit if you are, because they're using a lower interest rate to calculate your lump sum, which of course produces a higher lump sum payout. If you're not grandfathered, you use the present value segment rates, which are based on corporate bonds. And this chart here shows an average of those 3 segment rates over the last 3 years. Back in 2018, the average of the segment rates was 3.97, whereas what we had just been announced on the fourth quarter 2021 interest rates, if you retire and take your pension in the fourth quarter of this year, the average of those corporate bond rates is 2.27, a drop of more than 1.5%. And the relationship that we remember is for every 1% decrease to the interest rates, you can expect about a 10% increase to your lump sum. So many of you have probably made somewhere around 15% on your lump sum in the last 3 years, purely from interest rates, not even counting the increases seen because you have more service. But on the other side of the coin, if interest rates go up 1%, you could see a 10% drop in your lump sum. And this is why it's so critical to pay attention to these interest rates. They change the rates quarterly, both for grandfathered and non-grandfathered employees. They have a look back period that allows us to actually predict where the rates are going in the next quarter, which also allows us to walk away with the most amount of money or choose a good time to elect our benefit. And you might not want to take your pension right when you leave ExxonMobil. You may want to defer the election of your pension if either you are not yet age 60 and have age penalties still, because you can still age out of the penalties even after you're retired by waiting to take your pension, but also because the interest rates may be changing. And if they are staying flat or going down, you might want to wait to take your lump sum. If, on the other hand, they're going up, it might be a catalyst for you to pull the trigger and do your lump sum rollover, whether that's into your 401k or into a traditional IRA outside. And there's also some considerations if you have a supplemental pension on the income that's going to produce the year you retire, as well as the tax burden that's going to produce when you retire. So a lot of big considerations on this lump sum, but the opportunity today is to consider taking that lump sum if it makes sense for you. And there's a lot of reasons you might consider a lump sum. There's also a lot of reasons you may consider a partial or full annuity. And we have to run a cash flow analysis and go through a detailed conversation about the merits of both options before we can start to understand what's likely going to be the best bet for you and your family, given the information that we have available to us today. Now, many of you have probably, if you own your home or maybe multiple homes, seen some increases to the equity in your homes. We've had a lot of our clients refinance their homes, whether to lower their payment or to get some money out of their equity in their home, or maybe just to reduce the total years on their mortgage payoff. But you have to remember, your home is an asset, and we have a lot of clients that are planning on leaving, whether it's leaving Texas, or we have a lot of people moving to Texas from other states, as it turns out, because of the lower taxes and no state income tax. Remember too that the state in which you reside in retirement is the state which the tax laws will be in force in retirement. Even if you worked in a state without income taxes, if you move to a state with income taxes in retirement, this is something you need to plan for, because you will continue to pay taxes even though you made that money in a state that didn't have income taxes. A lot of clients that have moved from states that have income taxes to states that do not have income taxes on their retirement withdrawals, just to save money and be able to spend more of their own money in retirement. So this needs to be considered. I have some clients that are moving to be closer to their grandchildren in retirement. And this is a good time to capitalize on some of that equity potentially. Maybe the next year or two could be a reason that a lot of people are retiring in the next couple of years. I have some clients that have also moved to be farther away from their children, as it turns out. And so whether or not that's you, if there's a possibility you may move, whether it's to downsize, whether it's to be more tax efficient, whether it's to be closer to family or farther away from family in some cases, this could be a good time to start preparing for that sale of your home and start looking at what might be your forever home or your retirement home. But we don't anticipate the market to slow down, or at least to reverse course anytime soon. And there's a lot of statistics that are produced by a variety of different solid sources, one being the National Association of Realtors, that suggests that because of the high replacement costs and replacement costs of a home being a floor for value, many of you have seen if you're either building a home or buying a home, cost of lumber, cost of materials have all gone up. Lumber has started to come back down slightly just recently. But these are a floor for value. So this gives us confidence that the real estate market is not going to turn around so quickly. And there's a lot of differences in the current market when compared to the market back in 2007. Many of you remember the reversal of the real estate market during the financial crisis. And so our point here is that this needs to be considered as a part of your retirement plan, whether it's because you plan to move, whether it's because you can lock in a lower rate and maybe leverage the credit that you have going into retirement. As it turns out, it's not impossible to get a loan after you retire. There's just different ways of proving to the lenders that you are creditworthy. And oftentimes we'll help our clients with this just by proving the assets that they have or proving that they have a certain amount of income coming from their portfolio, which lenders like to see. But oftentimes it is better to secure financing while you have that paycheck, because a paycheck from a company like ExxonMobil, for instance, is probably looked at more favorably by a lender than a paycheck from yourself through withdrawals from an IRA, for instance. So make sure to build this into your plan. We'll put this into your cash flow analysis and talk to you about ideas on how you can use your real estate as an asset. But everybody's different in terms of their plans, and we first have to know what you're likely going to do, move or stay where you are after you leave ExxonMobil. Now, inflation is historically very, very low, but we have seen some increases to inflation, especially like we just talked about in materials and real estate. We're likely to see inflation in many other areas of our economy, which can be a detriment in a retirement portfolio, especially if you're on a fixed income. Now, many of you probably know that Social Security is adjusted for inflation. You historically have given a cost of living adjustment on Social Security benefits. Inflation can hurt your pension payout if you take the annuity, because the annuity option on the ExxonMobil pension does not get cost of living adjustments, meaning that if prices of everything we're buying go up in retirement, the value of our pension is actually going down because the nominal amount is staying the same. So this needs to be considered, and fortunately, one hedge against inflation, real estate is a reasonable hedge against inflation if you have any, and stocks are historically a good hedge against inflation. And most of our clients can't afford to not have stocks in their portfolio, but certainly you wouldn't want to have all your money in stocks once you get retired. So this is where we have to understand what's your cash flow need, what's your risk tolerance or your appetite for growth, as well as your ability to handle fluctuations in your portfolio. And then ultimately, what kind of cash flow does your portfolio need to produce to meet your and your family's needs and whatever your expenses are and what you predict those expenses to be. But we have to account for this in the retirement plan. And now inflation is low. As it turns out, inflation and interest rates are correlated. Interest rates being low, like we talked about earlier, great opportunity to retire if you're considering at least a portion of your pension to be taken as a lump sum. But as interest rates start to creep up, we are going to have to account for that in not only the timing of our retirement, but also the allocation of our investments. And unfortunately, when interest rates go up, fixed income investments like bonds lose value. We need to be cognizant of that when we're putting together this plan. And then last but not least, understanding the current environment that we're in, stock market at all-time highs. Folks, there's still bargains available in the stock market, but there's less today available than there were certainly 10 years ago. And so that's part of the reason the retirement group focuses on value investing. We have an entire 3-seminar series on value investing and how we create a retirement portfolio and why we do it the way we do it. Turns out value investments also have performed better than some of the more expensive alternatives in the growth sector in inflationary environments. But we go through this checklist of things that we think that are important to consider as you're planning for retirement. So how is your portfolio allocated? Who's helping you? You might do everything on your own. A lot of people don't because the stakes are so high in retirement. There are no do-overs, as you know. So most people will have at least some help, whether it's a financial advisor, maybe it's a family member, but somebody they have confidence has done this before and has a track record of success in helping people not run out of money in retirement and not overpay in taxes. Understand the costs of that service. That's the trade-off, of course, is if you're going to get help, there's going to be some form of cost. And the retirement group over the last 30 years has done our best to keep our costs competitive and as low as possible without sacrificing on the value that we bring to the table to our clients. But everybody's different in terms of their portfolio, how much they keep in ExxonMobil stock, how aggressive the portfolio is. That's going to determine the fee, but it's always going to be less than 1%, regardless of who you are and how the portfolio is set up. And then also understanding what value you're looking for. Some people are purely just looking for net of fee performance, growth on the portfolio, and the interest that needs to be shelled out to produce the cash flow that you and your family need. But there's a lot of other value propositions you might want to look for. Somebody who understands the ExxonMobil benefits our clients have found important to them to make sure they don't make any mistakes when they're transitioning from the company. Somebody that understands the tax code as it relates to retirement accounts, we think is incredibly important because one small mistake could cost you tens of thousands, if not $100,000. So just make sure that you don't make them, and have somebody that you're confident can help you to avoid those mistakes is critical, in our opinion. Somebody that has a track record, can offer references maybe of people in similar situation as yourself that have had a successful retirement transition. And what we think is incredibly important, and not every advisor does, unfortunately, is having a complimentary and detailed financial plan. Something we do, first of all, as an effort to get to know somebody and for them to get to know us to see if it's a good fit, but also to add some value to your plan so you can see, number one, do you have enough money to retire? If not now, when's the best time? And ultimately, what's the best way to get there? How do you minimize your taxes on your stock? How to minimize your taxes on your pension payout? How much risk do you have to have a successful plan? What's a rate of return you should be targeting? What are some ways to hedge against the risk of inflation? When's the best time to pay off debt? When's the best time to take Social Security benefits? There's all these decisions you're going to go through, especially if you're somebody where building an estate or leaving a legacy is important. And these are something that we are delighted to help you with and would like to at least talk to you about, even if you're not sure yet if you want to become a client. We want to spend some time with you folks. So take advantage of all the complimentary services we have available. Don't be a statistic. They say that 74% of Americans over the age of 50 do not have a written plan for their retirement. We think this is unacceptable, folks. The plan that we put together is complimentary. There's a whole host of different advisory groups that would love to earn your business, and we're one of them. So we'd love to spend some time with you if you're willing to spend some time with us, and we're confident it's going to be a good investment of your time. The QR code here on the left will get you access to our calendar, an advisor that is close to you and that understands the ExxonMobil plans. QR code here on the right, again, is the access to our LinkedIn page if you'd like to follow up on upcoming content that we have related to the ExxonMobil retirement plans. Or you can just call us at the home office at 800-900-5867, or just send us a quick email if you have a quick question at info@theretirementgroup.com, and we'll do our best to help you out in any way possible. One last story before we wrap it up here. I'll have one client that, because she's having to go back to work, she was able to work from home for a while. And because of the stressful commute, what she did was just put her resume out there. I think she used LinkedIn actually. And she found a job that was similar to what she was doing at ExxonMobil that she can not only do from home, but that she does not have to do 5 days a week. I think she's only going to be working 3 days a week. She just retired. I have another client that he just got introduced to us recently, and he found out that he had enough money to retire. He had no idea how good of a situation he had. But as it turns out, after he retired, he decided that he was not ready to be home 24/7. I think maybe his wife was not ready for him to be home 24/7, more so than himself. So he actually got a job at Lowe's where he's working the swing shift, the afternoons. And I think he's only working about 3 or 4 hours a day and only a couple days a week. But he has enough extra money to just, we call it his mad money, do some things that he wants for his own pocketbook, but it's not part of his requirement for his retirement plan. So whatever retirement means to you, we hope that you find it, and we hope to be a resource in helping you get to where you need to be to have a successful and comfortable retirement. Thank you, folks, for joining us today. Patrick, I'm going to pass it back to you if you have any last minute ideas or any housekeeping issues before we wrap it up for the day.
Yeah, thanks, Tyson. I have something to add, and we also have a few questions to get to. So first and foremost, in relationship to the real estate thing that you were referring to as one of kind of the newfound aspects of the cornerstone of where your net worth and your assets and future comes from. I recently had a projected retirees planning on leaving this year, and one of their concerns was how do they fit into their budget if they decide to retire the home that they've always been wanting in Florida. And so as it turns out, we had a discussion about the equity that they had in their home, and they did some shopping down in Florida, and as bottom line was they had enough equity in their current home to pay cash for the house that they had in Florida, which they decided to do. And so in turn, what we did to the cash flow or the financial plan for them was to build in the added cost in a separate line item so that they could have some comfort knowing that the added expense for taking this out of their current home, as far as the equity is concerned, because the interest rates are so favorable, to ensure that they had a very comfortable and enough padding, if you will, and separation in their need for income for regular expenses, plus their vacation home, to be able to make this work and feel comfortable about it. So again, as a piggyback off of what you had mentioned, that if you hadn't thought about the values of what you have currently in the home because of where the interest rates are and so forth, you might want to consider that, because that was certainly something that worked out for that particular couple. So quick question that we have two questions. One is, where do you see the interest rates going next quarter? And this is a great question. So if you want to maybe elaborate on this, Tyson, this would be great.
Yeah, great question. So next quarter is the fourth quarter. We know what the rates are. The question is, number one, whether or not you're grandfathered. And number two, if you're not grandfathered, how old are you? Because as it turns out, your age is a factor in what your lump sum payout. The reason is because there's 3 segment rates, and the third segment rate actually went down for the fourth quarter, but the first and second segment rate went up. And so the effect on your lump sum is a function of how old you are. The younger you are, the more relevant that third segment rate becomes. So, it also is a function of if you're not yet 60, you'll probably see an increase in the fourth quarter. So the answer to that question is it depends. And fortunately, the calculator on the ExxonMobil website is now updated because they made those rates official, I believe just last week. So if you go in there, you can run a benefit commencement date. And remember, the timing is important and also a factor or a function of your age and whether or not you're grandfathered. If you're grandfathered, you can actually work all the way up to the end of the quarter and still get the fourth quarter interest rate. As it turns out, they'll actually still give you your vacation pay for the next year. However, if you're not grandfathered, you have to have commenced your benefit by December 1st in an effort to get the fourth quarter interest rate, which means you actually have to be retired by November 30th to get this fourth quarter interest rate, which is probably, for most people I've run these projections with, more favorable than the third quarter. Many of you saw big losses on your pension from the second quarter to the third quarter, but it's likely that you've actually made money from the third to the fourth. But again, it's not going to be the case for everybody. It's going to be a function of your age. And the older you are, the less relevant the third segment rate is, and you may actually be losing money going into the fourth quarter. Now, to piggyback off of that, the first quarter interest rates are not yet known, and we should know those probably by the third or fourth week of October. And our opinion is that is the one to keep an eye out for, because rates are still very low, but for both the Treasury and corporate bond rates, they're so low right now that eventually we're going to see a big spike in rates. And you should be paying close attention if you're anywhere within 2 years of retirement, because it could be the catalyst to leave the company and save tens of thousands of dollars on your pension. But to answer the question, it depends on your age, and I'd encourage that person to either run a projection on the EDA website or the external benefits website, or just call us if you're not as familiar how to do that, and we'll walk you through the process.
Yeah. Another good question here is, and this is kind of tied to what we just covered with respect to the interest rates, is would inflation have any impact on my lump sum?
Yes, and it's not a direct correlation, but remember that inflation and interest rates are correlated. Because think about this, if you are an investor and inflation is very low, you might not demand as high of a return on your investment if you were to, say, buy a bond, like a 10-year treasury bond, for instance, which, by the way, is at 1.2% right now. It dropped significantly in the last couple of months, down from about 1.6%. And that 10-year treasury is a benchmark rate that we follow for a lot of reasons. It doesn't calculate your pension. Your pension's based on either the 30-year treasury if you're grandfathered, or the short, intermediate, and long-term corporate bond rates if you're not grandfathered. But when inflation starts to go up, investors demand a higher return on their safe assets like bonds. And that's part of the reason they're correlated. We also have our Federal Reserve that doesn't control long-term interest rates, but they control short-term, what they call the federal funds rates. And they also manipulate bond interest rates by buying and selling government bonds traditionally. But just recently in the last year, Federal Reserve maintained the right to buy corporate bonds to keep those interest rates low. And this is also something that you need to pay close attention to, because once that tapering off happens, once they either slow the buying program of corporate bonds, or even worse, reverse course and start selling corporate bonds back on the open market, guess what's going to happen? Interest rates are going to start to go back up. So pay close attention, folks, or at least just continue to pay attention to these webinars or talk to somebody that follows this, because it could be a very quick and extremely detrimental increase to interest rates that could make or break your retirement if you're not paying attention.
Yeah. Okay, just in the in lieu of extending this a little past what we normally do, because we try to keep these around 20 or 25 minutes, and we're way over that. These are great questions. One final question: can you go over the grandfather status again for them, Tyson, just so they know the ability for them to pay attention to which rate?
Yeah, sure. So it was back in 2012 they made this change, and really what you need to know is that if you are 64 years old, or at least 64 years old, with at least 24 years of service by the end of 2021, by the end of this year, then you are grandfathered. If you are not either 64 years old by the end of the year, or you don't yet have 24 years of service, you are considered not grandfathered. And that includes you if you work for XTO because of the timing of the merger back in 2010, which just means you're using a higher interest rate and you have a little bit different timing rules on your retirement. So as you can see, grandfathered folks are a dying breed. There's not going to be anybody grandfathered eventually once the last grandfathered person retires, but at least 64 with at least 24 years of service by the end of the year, and you're grandfathered.
Yeah. Okay, folks, listen, thank you very much for your attention this afternoon. These were great questions. A quick reminder, and I did not mention this at the beginning, but you're going to end up getting a survey from us. And one of the most important things from these webinars that we do is the feedback that we gain on the things that you enjoy about these webinars, and maybe even things that you think we could improve upon. So it's important to get as much feedback from you, because these are designed for you, and they're educational, of course, to the extent you wish them to be. And so if you would, please take some time to fill out the survey you're going to end up with. And for your trouble, we'll send you some Cheryl's cookies to enjoy for getting that response to us. So again, thank you very much for your time. We appreciate your attention in the series that we did, and we'll see you the next webinar. Okay, you guys have a great day.
Thank you, folks.